Flipkart had just happened, the biggest exit, that gave the boost to venture capital in general in India, being early investors in Paytm, quite a few other startups, putting in your own money. That gives the most confidence to an investor. There was no FOMO investing. We don't, look at founder pedigrees or Ivy Leagues. AI generated videos of the whole pitch. Even a very good pitch deck won't lead to good funding. Tech or non-tech, we want to see where the money is. So many startups shutting down and returning the capital. Now you can see slow growth but sustainable.
Hello, everyone. Welcome to the Breaking Uneven podcast. We love to talk shop, uncover the beauty of failures, and play a few games. Today, we're switching it up a bit. So, today we delve deep into the world of venture capital with an expert. We're joined by Gaurav Navani, a senior associate at Roots Ventures. Gaurav, since the get go, you've immersed yourself into financial, business, operational analysis. And so, we'd love to begin with this and kind of figure out, why is it that you're here today? So why don't you just give us a bit of your brief history and how it's impacted where you are today?
Right. So it's been about 7 years that I am in the industry. Prior to this, I was at an auto ancillary firm called as NRB Bearings, listed firm. And there I was directly working with the CFO, primarily everything into finance. So all her M&A projects, strategy, costing, financial analysis, the works, and I used to be a part of it. And then what struck me is that I saw myself looking at startup news. It was about 2019 that all of the funding rounds was happening. Flipkart had just happened, the biggest exit, that gave the boost to venture capital in general in India. And that's where I realized, and even my boss, the CFO, told me that you're done learning here and you need to move to the next path. And I saw naturally myself in the startup ecosystem. And to be in the ecosystem, I had two options: to be a founder or work for a startup, or be on the other side as a VC, where you can understand the plethora of companies. And that's where I started applying to multiple VCs. I realized that it is so tough to get in. First of all, the uh, industry is so small. The teams of every VC is so lean that you need Ivy League or some network to get in. But that didn't stop me. I cold emailed quite a bunch of VCs, and there were a few kind enough VCs to respond and got in an interview. Got in, and now it's been 4 years of that, and that's me here. And to give a brief on the fund that I work for, it's Roots Ventures. I started very early on at the first year of inception of the fund. The two partners had prior experience in being in the ecosystem, launching previous funds, being early investors in Paytm, quite a few other startups. And I joined in the first year of operations. And then we recently increased our team to 6. Now we are just a 6-member team. So when you would ask me what do I do, it's everything. It's starting off from fundraising, where we just recently will be announcing our fund close for the second fund that we launched last year. So from fundraising to helping, there's something called as LP. Just stop me whenever there is any VC acronym that I just shout out. So for all our podcast listeners to give a idea of what that term is, I will happily please interrupt me and then I'll stop. And so I was coming back. I was talking about there are LPs which are called limited partners, and so those are primarily the investors in the fund. They give the money, and then we deploy that capital to the startups. So starting off from fundraising is what I was handling, assisting our so that is LP, and the one who is looking after the fund is general partner. So assisting the GP is what I was doing in terms of fundraising. We got government funds on board, ITC in the first fund, and quite a few HNIs and family offices. HNIs would be high net worth individuals. And so that's primarily on fundraising. From the first fund, then starts in once you have accumulated the capital, you start deploying that capital. But before that comes in SEBI and all the regulatory bodies to even launch an AIF, alternative investment, and that's where you start in deploying the capital and evaluating companies. And there are multiple companies you look at day-to-day basis. So talking to founders on a day-to-day business, understanding their model, what they do, and that's on the evaluation part. And when we understand, when we like some company, deep diving in that sector, in that competitors, what they are doing, what different are they building, and that's on the evaluation perspective. Then comes regulations, wherein you're doing a lot of compliance because you're handling someone's money. Of course, SEBI comes in, and there are quite a few regulations that uh, allow us to be stringent in terms of handling their money. So that's on regulations. And then the companies that we have invested in, after the due diligence is done, we end up monitoring that company, our portfolio takes up a lot of time. However we can help them in any sort of way, day-to-day interactions with the founders that we've invested in, helping them fundraise further. And yeah, that's the idea. I gave uh, a very longer answer to what I do on a day-to-day basis in multiple sub segments.
Yeah, no, sounds good. But like, I guess you got the best of both worlds in terms of your team's so small that you have to get involved in everything like a startup, but you also are on the VC side of things. So that's pretty cool. You want to start from scratch. Like, we want to assume that, I guess you can assume that none of us know anything about the VC space, and we want to first like educate ourselves on like either terminology, but just the processes of what the VC world is all about. So to start with, if I were a founder and interested in like the fundraising space, how does one begin that process?
Primarily would depend on what stage are they in. So let's assume it's a seed stage company. They pre-revenue, just gotten an idea. So the first step ideally would be bootstrapping it, putting in your own money. That gives the most confidence to an investor that without any capital, out external capital, they can start off with their own money. That's the confidence they have on their own company. So bootstrapping it first. If they don't have the resources, that's where they look for maybe government grants, or else there are specific seed funds or accelerators that help you just on the ideation phase. They help you build the company from scratch. Obviously, the commercials in terms of them acquiring a stake, in terms of capital that they put in, would be higher. Let's take Y Combinator, for example, where they have, I don't recollect the exact commercials, but they have a specific maybe 7 or 10% at 100K to 50K. So that's the template that they use. There is similar 100X we see in India, which does that for about 25 lakhs. They give about 7 to 10% again. So there are specific seed stage at ideation phase, which allow you to do that. We come in, I will talk for ourselves as the fund, we come in at a pre-series A stage, where we've seen some traction in terms of revenue, and the company has grown, and that's where they see further potential for growth and would need that capital, potential capital, whatever they are seeking for. And that comes at a later stage of post-seed stage.
Fair enough. So yeah, seed, pre-seed, all those words. So can you tell us the different stages of fundraising from start to end, and like what these stages of each company would?
Right. So it depends a lot on market sentiment also, because we've seen companies like Cred at seed stage, they would have gotten a larger round of fundraise. A typical scenario is anything between even 100K to 2 million would what we call as seed stage. But and then later on pre-series A. So there's no amount fixed to each round, but yeah, that's the usual seed, pre-series A, series B, C, D. and then in between there's a bridge round when they are seeking for a larger round of fundraising, but just for the in between bridge is they'll take in lesser amount of capital for that period. So honestly, there's no such template of bifurcating each Series A, Series B at this amount. It's very vast.
No, fair enough. And there's, as you mentioned, like there are different companies that are trying to get to different scales, different funds, so the amount can vary, and like there are industry averages.
Absolutely.
But in many cases, and when you look at probably seed stage investments, there is a mindset of the VC and the founder in both cases to do a cash burn for like growth, right? Like it's what Uber did, it's what Swiggy, Zomato, most tech companies do, which is like burn cash, get a product out there, grow, and then you can figure out how to monetize further, lean up the company. What is your view on that mindset, and how does, like, for example, Roots Ventures look at that mindset?
So, for us, we've always stayed away from cash burning companies. And now is the sentiment as well, the market scenario where everyone is looking at profitability. So early on, that was our focus anyway. We were never looking at, trends, or there was no FOMO investing that, we never invested.
I need to have some investment in AI.
No investment in edtech during the whole COVID phase. No, our focus always was look where no one's looking. That's where you can make your most amount of money, and we stand by it. And that's what we've seen in our fund performance as well. So coming back to the profitability part, where our focus always would lie on the capital efficiency or repeatability as metrics. That's one important metric that we keep looking at, especially for early adaptability and PMF, where if your current users who are early on of your version of your product with whatever limited capital you have, if they are repeating, that shows promise to your product or service, and that's one important factor. We look at sorry, I'm diverting, and in terms of looking at
keep going, go down the rabbit hole.
diverting in terms of looking at what we see in a company to evaluate it further as to why we would like it. We don't look at founder pedigrees or Ivy Leagues. What we primarily would look at, the founder sometimes gets so invested in their product or service. One important metric is for us to look at if they can sell their story, if they can narrate their story, and it's not only to other investors, it's to the customers.
Customer, yeah. How good of a salesperson are they?
Yeah.
Exactly. So, product is very overrated. What is primarily important is distribution. If that can reach masses, and that's where we are coming in, right? We are financial investors. We call ourselves backseat drivers, not wanting to get into operations. We understand that the founder knows their job. We are just giving capital as a moat, and that's where we would want to stay away from driving the business. And that's where we want to just look at founder ability to sell, distribute, and that's where we are coming in terms of the market size.
Fair. So when you say, like, our job is to be backseat drivers, we come in based on market size, etc. Now that's you speaking as a VC, right? As Roots Ventures, and there's a lot of different types of funds and investors. Right? You've got funds whose theses are focused purely around industries; they're not industry agnostic. Then you've got different types of investors who go in at different stages for different percentage equity. So can you talk us through that? Like, let's say in different types of investors, so angels, VCs, private equity, etc.
So angels, as we call them angels, they would be the initial backers. Primarily, those rounds are run by your own network. You reaching out to someone on LinkedIn, Twitter, and via connections, all of that. So those HNIs would be investing in your fund. We have angel platforms as well. Angel List is one. There is IPV, where you put in money, and Inflection Point Ventures, and where you put in money, and they would give you a plethora of options and startups to invest in. and yeah, those are angel and angel platforms. Then we have proper VCs at multiple stages, like I mentioned, specific sector focused VCs, sector agnostic VCs like us, and stage focused VCs as well. And then we have corporate venture capital arms as well, who would just be looking at strategic investing. Their core, expertise is bringing in what they already have and a new technology in their current scheme of things, wherein an ITC investing in yoga bar, or JBL investing in boat, not boat, sorry, noise, which just recently was announced. So these are still proper corporates investing in the companies, but they are venture arms.
It becomes almost more like an M&A kind of thing rather than pure.
At a later stage.
Yeah.
So that's what happened with us in our first fund, where we'd invested in a company called as Just Herbs, and very similar to likes of Kama Ayurveda, Forest Essentials in the luxury beauty space, and they were acquired by Marico. So it was a strategic buyout. So and that's where they are expanding. So proper exit for us, and then Marico coming in as a strategic investor and buying us out and investing in the company.
And where does private equity come into this web?
So, VC is a subset of private equity, I would like to say. Private equity would come in at a later stage, where it would be established companies, cash rich companies, profitable companies, and then seeing further growth. So, like a Wabus Pincus coming in for boat at a much later stage. That's
And
an idea.
EPA,
Yes.
PPA equity, yeah, there's quite a few of them.
Quite a few.
And-
KKR Capital.
KKR. And they all operate in the same manner, right? Even they have like very lean teams and they're handling like billions of dollars of.
The only difference I see, a stark difference, is their focus on the financial model, wherein the forecasting or focus on numbers, wherein at an early stage, we just can't rely only on numbers. We have to look at so many other qualitative factors that for a PE it anyway would be established, because
Yeah.
they've grown that much.
Yeah, for you, there's not even enough data on numbers, right? If you're looking at 2 or 3 years of a company's history, what will the numbers say on that? The next exercise is actually a pitch deck analysis that we want you to do for a company that we all know. Some of us love it, some of us hate it. It's Uber. So we found Uber's pitch deck online, and yeah, it's about 25 slides. We're going to show it to you slide by slide, but it's got a twist to it.
Okay.
What we're going to do is we're going to go slide by slide. Each slide you have 30 seconds to critique it.
Okay.
Good, bad, whatever. And then we'll discuss the critique if need be.
Sure.
And that's how we'll proceed through the presentation.
That works.
So we'll begin with slide 1, which is the title slide.
Okay.
All right, so 3, 2, 1, go. Critique it.
So I think for this day and age, what initially we have to look at or even consider is, this was back in 2007 or 2008,
2008, yeah.
right? Pre technology era where iPhone would have just launched. So
You can see the
yeah,
green.
the first iPhone maybe, or the BlackBerry
And
that was in
BlackBerry, yeah.
existence. So my only critique would be the one, even though it covers everything, the one line, it could have been more descriptive for me to even catch an eye on it. Or maybe if I think back in 2008, it still might not be very eye-catchy. What can be next generation car service? It needs to have something that is lacking, where it could be maybe I can't think of what it can be added.
But I get you. Car service is generally a term, even today, used for corporates, right? Like if you're a corporate person, you need a car service.
Right. So
It's
cabs already existed, right?
Yeah.
So
Exactly.
what
So maybe
exactly are they doing different?
Yeah.
At least covering that in one line would have made sense, is what I
Yeah.
think.
Cool. Slide 2.
Okay. So I think this is perfect in terms of the first slide that they want to bring in what is actually happening in the current scenario, and not really coming to the problem, but just talking about. They are actually talking about the problem as well, wherein the first slide needs to be eye catchy as to
Yeah.
where is it going next.
Yeah, and the problem solving part of it, right? Like
Yeah,
what
yeah,
are they
absolutely.
targeting?
Problem statement.
Yeah, it's actually captured really well.
being the core.
Very succinct and to the point. Yeah.
Yeah.
Cool. Let's go to slide 3.
Here, I think you're giving a glimpse on the model in a way, which would really, obviously, through an investor perspective, help as to where this is going in terms of revenue. So that's good. I think again, this is my first slide issue, wherein too much jargon, or I still wouldn't be exactly clear as to what they would be offering, or maybe I don't get the references of NetJets of car services.
Yeah, and it is a lot to keep on one, like
Yeah.
to plop on one slide.
Yeah.
Like fast and efficient on-demand car service, like that's a good. In fact, that's a good line even for the
Yeah.
first slide.
Yeah,
you know, if
yeah,
you think
yeah.
about it.
Absolutely.
Yeah.
That
That
should be
would-
that should
yeah,
have been the
yeah.
first slide. First slide.
Because I feel like now it's too vague.
Yeah.
It is.
Like in
And-
slide 4, you would want a little more,
Yeah, now you need the solution.
Solution,
You
yeah.
identify the problem.
Yeah.
What is the solution?
but that would have been a great line for the first line.
Absolutely.
And I think that it continues next, but there is no like you don't know yet that they're going to continue on
There's
the
too
next
much
slide.
built up.
Yeah.
Yeah. To the solution.
Yeah.
Yeah.
So this slide could have been earlier, and I think covers everything in what it would be offering as a solution to the problem.
Yeah.
So be it like a yellow cab doesn't give a guarantee pickup, or you need to be a member to use such a service. Yeah, I think this is a good slide too.
I would also say like this slide would have been nice right after the problem statement. Like you still
Yeah.
have the problem in your mind, and now you're like saying what the solution is,
Yeah, absolutely.
instead of like there were 2 slides in between where I was like going a little roundabout. But yeah.
Yeah, fair. So then we come to the differentiators. This is an important slide.
Yeah, talking about the features of what it will be giving. So I would assume Uber was the first company in its
Yeah.
Yeah.
as a cab hailing software, right? So
Even in terms of its model, right? The business model.
Gig economy and stuff.
Okay.
Like,
Oh, was it
they're-
Airbnb was before that?
No, but they were all,
Airbnb also was 2008.
right.
these
Yeah.
are all considered as the start of gig
Yeah.
economy.
Yeah. So this would be a very important slide, because now we understand all the terminologies or the model.
Yeah.
But to explain an investor as to how they would be different, or how they would be going about the app, this is a very important slide to begin with. But I don't understand. So Uber started only with luxury cars, is it?
Yes, yes.
Oh, okay.
In fact, even I don't know if you know this, but when they came to India, Uber came and
With Uber Black.
Uber Black. So you used to have Camrys and stuff like that.
Yeah.
But that didn't last it didn't last very long at all here. In the US and stuff, that was still their business for almost a year and a half, 2 years. In India, I think within a few months they switched to what you see today, Swift and everything.
Yeah.
And I remember I started using Uber to go to school. Once they switched to the Swifts, because then it was actually at that time cheaper than a rickshaw.
Yeah.
And everyone in school used to ask me, how do you come to school? I said Uber. And they thought I was some filthy rich guy coming to school in a black cab.
Yeah.
And all that. I was
Yeah.
like,
But then the car service makes sense, because I relate car services to luxury cars,
fair, yeah.
like
I think-
Memorize
yeah,
or
it makes
like
sense. It's
things
not
like
just-
that.
But
Yeah.
you
Now
can't
it does.
identify a problem as the average.
Yeah,
yellow cab.
that was.
That's all then.
Yeah.
Because a luxury car is not a replacement for a yellow
yellow
cab,
cab.
unless you're doing it at that rate.
I don't think they were.
And I don't know actually.
I think they might have
Because yellow
been.
cabs are very expensive. It's a
Yeah.
luxury there, like a yellow
Yeah.
cab.
Agreed.
Maybe
but still,
what they were
I
trying, that was one of the differentiators, that you'll get a similar pricing, but
think- yeah.
Yeah.
the luxury aspect.
It might be subsidized for a luxury car, but I don't know whether it would be equivalent to a yellow cab.
Maybe, yeah.
Like a black cab out here also would be cheaper than like a day rate luxury rental, but like
No, here to the economics are totally different, but like there, I think the difference is also, I think over time, what's happened is an Uber X is the equivalent of a yellow cab,
Yeah.
and then you've got an Uber Black, which is like there's a huge
luxury.
difference in
Difference, yeah.
pricing now. Yeah,
Yeah.
yeah. Operating principles is
The luxury service on demand. So it was more luxury focused back then.
Yeah, again, I think it's just continuing.
what if you were to compare these two slides, the key differentiators and operating principles?
I think the first one, the key differentiators, makes a lot more sense in terms of actually understanding the features. The second slide is just add on to what we've already seen.
Yeah,
is
it
what I
seems
feel.
like it's almost unnecessary.
Yeah, but now that we think of it, there are so many companies that's what we see in our pitches. Uber of this, Uber of that.
Yeah.
So it's become like a term.
I think that to me at least, see, I'm not particularly ingrained into this world. Like I know a lot about it, but I'm not a VC or anything. But I think that might be something that started with Shark Tank US, because there, way back when 6-7 years ago, people started pitching it like that. Like when the sharks weren't understanding what exactly the founder, just think of us as the Uber of this. And then it became like that for everything, like the Tinder of crowdsourcing, the
Yeah.
Uber of this,
Yeah.
and like, it just blew up.
Because I think it's just
Got it.
relating it to a business model, right?
It
Like
makes-
this is like the way it
No,
is set
yeah,
up.
yeah, makes a lot of sense
At
to
times
ease out.
it makes sense because your business model is a very strong parallel to that.
Yeah.
At times it's just fluke. Like I think it's just random things that
Fluff.
people say. Yeah.
So again, I'm giving them the benefit of the pre-digital era because here the actual slide could have been the app features or when
iPhone.
what the app is on and not just the iPhone and BlackBerry.
Yeah.
So yeah,
Was it
again,
an app? Because it's saying SMS from any phone. So I don't think this. I think this was like pre-app also.
wow.
Maybe actually.
I think somewhere above I saw it.
I mean, the name of the slide is Uber Cab app,
Yeah.
but I think it might not actually have an app because it says like SMS from any phone, pick up at work in 5.
They had a website. So yeah, I get what you mean. It's not very clear what is it actually like. There's app and then there's .com, and .com is giving you more functionality.
Wow. Just look at the Google Maps integration. All of
Yeah.
that we had to do that. Right now it seems so ridiculous.
Yeah, but like through this, we don't know exactly what stage or like what they start. Like it's not clear as to what their model was.
Yeah, and if I'm gonna think back to like 2008, am I thinking that so to access the full thing I need to carry my laptop with me?
No, I would say like more of the, like Meru Cabs was there.
Yeah, I know. So I'm saying, so to be able
I
to,
feel like it feels that vibe.
but it says
Yeah.
book trips, show fleet status, trip history. So for all of this, I need my laptop, right? Basically, because it's ubercab.com.
Yeah.
Web browsing on the phone was like barely a thing back then.
And then the no clarity on SMS part of it,
Yeah.
where you're just
This is more, I think, a presentation that needs to be presented rather than a deck that you can send.
absolutely.
Yeah.
That's now that you've said it, it's such a difference where both of that needs to be one, where your deck can just talk for itself, and it can be an add-on to while you're speaking and narrating your pitch.
But I know a lot of founders that make multiple versions of their deck
Yeah.
at the same time. It's not like evolutions, like literally the same deck, which is might be getting a little ahead of ourselves, but like the same deck in 5 slides, 7 slides, 15 slides, and then if I need to present it, if I'm going to present it, then this is what I send, and if I'm just sending it, then this is what I send. What do you think of that approach?
So there are multiple now. In fact, now you have AI version, like a video, AI generated videos of the whole pitch, and because now that everyone's consuming
Yeah.
video content, the video is the pitch rather than the whole deck where you go through it. So yeah, you see multiple kind of versions that go on. Then there's a teaser which bankers send, and there's an IM, information memorandum, which is like 30-40 slides, which has proper details of everything. So yeah, there are various kinds of decks.
Interesting.
What's your thought on like it being AI generated. Like I feel like the pitch at least should have some sense of like the founder.
So, not used to it yet. We just saw one or two, wherein, yeah, it wasn't. It
Like
doesn't give the
the
essence.
connection is in
Yeah.
there.
Yeah, yeah.
There's no passion.
Yeah. Or like there's no personal touch. Like what differentiates you from
Yeah.
someone else? I don't know. I mean, I might be saying this, and like in 6 months, it might just be AI deck.
Yeah.
So
Yeah, use
With
cases
this
I think
is
is good. It's
Yeah.
just a quick, simple slide.
This should have been earlier.
User
what I feel.
benefits.
but now it's so confusing because like the use cases are such generic things. Like why would you need a luxury car for any of this? You know what I mean?
Yeah.
Like it's just
So I
luxury
think
or
they were
not
trying to replace the yellow
Yellow
cab
cabs.
with a luxury
luxury.
cab,
Okay.
which didn't work out eventually, but they pivoted enough times to still figure it out, I guess.
Yeah, because like trips to and from restaurants. I guess
Dropping
that
off
okay.
kids
Yeah,
at
dropping
school,
off
yeah, elderly transport.
Unless you want to show off throughout.
Exactly. User benefits should have been earlier. Because this again, like cabs don't guarantee pickup, that's an answer to a problem. So
Yeah,
See, they are comparing it to limos. I think cabs aren't as safe or clean as limos.
Yeah, the traditional limos
Yeah.
that they are comparing it.
Car services require 1 to 3 are noted.
Uber cab would be faster and cheaper than a limo.
But nice and safer
Yeah,
than
so they're
taxi
clarifying
drivers,
it on slide, like, I don't even know what slide we're on. 11. Yeah, it's quite late
Yeah.
in the deck.
Yeah, all our questions essentially got answered now.
Got answered now.
Wow.
Yeah. Environmental benefits. That's interesting.
And that's earlier than
Yeah, this wasn't as much of a thought today as it was back
The
then.
ESG.
How many ESG like slides, like does every pitch you see nowadays have something to do with
Not
ESG
really.
or
The ones in agri or actually the circular economy that you call it, those obviously
those of
would
course
have.
would.
Yeah.
But is that
But-
something that like if you're, let's say, a manufacturing company and you have some kind of sustainability angle, would that affect your interest in the startup?
Not completely, but it does help that they are doing that, but not in terms of an investment perspective.
Wow, they were doing S550. That's a fancy car.
Standard
Lexus.
Lexus.
So yeah, this is where you see Uber Black and Uber X.
just Uber Black.
But yeah, a standard car to do an E320 is still quite fancy.
So the next slide, initial service area. This is not a good slide to have because you're just talking about what you're doing right now. Everyone wants to see where you're going. So maybe they would have covered different cities that they would be after raising this much amount, and their plan for the next 6 months, 1 year, what other parts they would be covering is what I think is missing.
And also proper roadmap. Like what you're talking about, yeah, just like a full roadmap. Just this is where we start and Manhattan soon after. That's not enough. Like,
Yeah.
Yeah.
So now we know they have an app.
Yeah. But this I think is a good slide because, and in fact, the key differentiator slide, which is pretty much about the service, should have been followed by this because now you're talking about proprietary technology coming into the mix, which I think is important to a VC, right?
Yeah.
Because that has inherent value that will always remain as long as you keep that up.
Absolutely.
I feel like if you also say everything should have come earlier, that's how you
Yeah.
end up with this order of slides. Okay, this level of detail, right, demand forecasting, how important is that for a VC to see?
This will help you gauge what kind of revenues that will be coming, and this is in fact helping for network effects also for Uber, right? So this is a very important slide in terms of the title, but content I am not sure of. But no, it does give a feature of how the network effects will work. So yeah, it does help. Oh man, this slide should have been the first slide, I feel, after the line, overall market. Venture capitalist always wants to see how big is the market. There are three terms, TAM, SAM, and
SOM.
SOM. So total actual market, Then there is
Total
serviceable,
available market.
total available market, serviceable available market, and O is opportunity. So basically, it's what's the actual.
Services. I think the third one is serviceable operational market or something. Yeah.
Yeah. So how it goes is actually how big
Like-
is the market that you are venturing into.
Yeah.
What part of it can what is the sub segment of that market that you can cater to, and finally how much do you think is obtainable
Obtainable. Yeah.
obtainable by you. So that's the part.
The
But you know,
market share.
so I have done a TAM SAM exercise in the past, and I just feel like it is so easy
To play with numbers.
to play with numbers. Like it is so easy. Like I can show a market being $100 million
Yeah.
actually, but then for the sake of this deck, I can amp it up to 2 billion easily by like taking better different
Yeah.
assumptions, or like finding differently skewed data. So of course, when you're a VC at first stage, you see the big number, you're like, okay, it's just like a check mark.
Yeah.
And then when you like, do you do your own research to just like,
Idea is to deep dive into how that number came from, whether it's coming from some random survey or primary research that's been done, and then properly deep diving as to all the assumptions that have gotten concluding to that number. So that's
all right, now I have one more question for you for numbers, right?
okay.
Imagine that I am starting what's a competitive market. Imagine that I'm starting a juices, like what do you call it, Tetra Pak juice company, and I tell you that okay, the overall market in India is 5,000 crores. My what I can potentially grab is 2,000 crores, and I'm going to tell you that my serviceable obtainable market is 15%, which is ridiculous. I'm not going to be able to do like. I, as a founder, I know I can't do 15%, but on my deck, I've put 15%. How would you react to that?
So depends what. So we do get such decks, but depends. They would maybe have a forecast of after 7 years is where they can reach to a 15%.
I know, but I'm saying fair enough.
That
So
is
what if the numbers don't add up? I'm sure that also happens quite often because not everyone is either trying to like swing around certain numbers or they're not that particularly great with numbers. So where you see the numbers not adding up, is that a huge red flag? Or could it just be that, okay, it's fine, this founder specialty is not numbers, so we need to do our own research?
So I think there needs to be a discussion wherein if there's a disconnect in the numbers itself, in the market size also, first we'll do our internal deep dive as to what those numbers actually should look like, and if there's a huge gap, and if we are still interested in the company, that is, or else we are just looking at a deck where we've just got numbers and it's passed, whether we are not investing in. But if we are interested in the company, so during the pitch, during the discussion, there is a whole
so it's
discussion.
It's not like
it's not
if
a
you see bad numbers, it's just
proper
like
red flag.
throw it
No.
out. Okay.
But I would assume the numbers is important, right? Like
Absolutely.
you want to know whether the founder is completely delusional about where it's going to.
No. Numbers that way is a founder needs to know what business they are running in terms of where the profits are coming from or what cost structures are placed. So that's a huge put off when we ask a founder, and if they don't know the usual numbers on the P&L on their running on their mind, that's a huge put off.
I would also assume like if they really inflate the numbers, that's also a red flag in terms of trust, like founder, the kind of person he is.
Yeah. Trust is the basis for any transaction, and that's not only for us. I think for most, it would be a primary factor to look at.
Like, so I'm part of an angel investing network, Mumbai Angels. So whenever I review a pitch deck, for me, if the numbers don't add up, I just like pretty much discard it, because I also feel like you need to have a good grip on numbers to be able to like, because at the end of the day, the motive is profit. So if you don't have a good grip on numbers, you can't tell whether a decision you've made has benefited you or not.
Absolutely.
in the moment. Like,
Yeah.
sure, 6 months later, you look at your P&L with your accountant and then you'll realize.
Yeah.
But that doesn't work.
This is just a segregation of
Yeah.
where they perceive themselves to be in. I don't get the 2007 market. That's just an
Yeah, I think
asterisk. is
maybe
it?
it's a
Typo?
caption rather than a
Okay.
Yeah. I think this percentages are from the 2007
2007
market.
market. Yeah.
Yeah, because I was also going to ask, like, where did they come up with these like random percentages?
Yeah, now they are
No,
talking
yeah.
about it.
So it is a little all over the place. Like the story
Yeah.
here is not very
This
straightforward.
How many slides are these?
25.
25? This
Yeah.
could have been cut down to 10 easily.
Yeah. Because
Try go for it.
I was saying that everything that we initially questioned is somewhere, but we're just
Yeah.
like looking for it.
Exactly. But tell me this, like now let's say you say bring it down to 10, right? In parts of this, yes, it's a repeat of information. But if I, for example, if you see as a VC a slide with a lot of information, let's say well laid out, but a lot of information, that's not a red flag as
Not
such,
at all.
right? Yeah.
Not at all.
As long as the story is fine, you can put
Yeah.
10 points on a slide, but
Story needs to continue
Yeah.
from the beginning, and they should cover the main aspects of a deck.
Like, even if it's not cut down to 10 slides, like the storytelling doesn't work here. So you could
Not
just
at all.
readjust the slides and it would
and
make
still
and
be
still
better.
make
Yeah,
sense out of it.
exactly.
Because we questioned this like 5 slides ago. So if it was just after that,
If you, the best would be to give this to an AI to create
Yeah.
a video pitch deck and see how all over the place the AI would be.
Yeah.
that's our next episode.
I like the honesty of the potential outcomes in the worst case scenario. Remains a 10-car, 100 client service. You don't see such kind of honesty in a investor pitch deck. It's always the extrapolation of numbers, how the growth will be. Here they've actually put out where they will be if they don't get the funding.
But you know what's interesting here is in the best case scenario, you're given a revenue figure. In the realistic scenario, you're given a profit figure. And then in worst case, you're given no figure. So, like, you know, even someone who's reading this, how do I compare the 3 scenarios? I need to have one number that is the same across all 3 to be able to compare it.
So you make absolute sense, but here it's just for the pitch in terms of the scenarios where they will be. So even if they are not disclosing the revenue profit in the best case scenario, they are
You as a VC
showcasing
are seeing it as
the
1 billion
highlight
revenue works
of-
for me. Yeah.
Exactly.
Interesting.
So I think it works.
I think they also don't want you to compare. They want you to just go to they want the best case to actually happen.
They're telling
right?
you that this is
Like,
what our story will be in each of these
sit
scenarios.
yeah.
Yeah.
I mean, I think they're like essentially telling what their growth is. Like right now, they are a 10-car service
Fair.
in SF, and then they want to become this, and this is where the VC would help.
It's interesting.
Yeah.
I think they're pretty much at best case scenario.
Also, they also want
No,
you.
they're not. No, they're not.
No,
Revenue नहीं है. Are they? Do they have that much revenue? I don't know.
we can Google that. Crores.
Oh, it's showing you like crores USD. What? It's a little confusing. 32 billion. So they've gone well beyond
Beyond,
best case
yeah.
scenario.
32 billion is the market cap or
Google
the
Giant revenue.
Revenue.
Revenue in 2022.
Sorry.
An 82% increase on the previous year. It made 14 billion revenue from
God.
ride hailing.
That's
Wow.
insane.
I mean, I think this best case was supposed to be for 2008.
Exactly, that should have been. That brings out to another point. All these potential outcomes is still what
What time?
Time.
So,
period.
yeah.
because they crossed it well beyond. The next slide is interesting to see that BlackBerry still had 32%.
How that has aged.
What requests are these? I wouldn't understand.
I think what they're trying to do here is
I think it's like saying from where people requested rides.
Oh, so maybe that sample size data should have been there, that these are out of
How
100
many?
rides that have come in, and that's then the bifurcation, right? Or is it
I
something
have
that we are
no
missing?
idea.
Very
I would
vague.
assume.
Very vague.
Because requests by OS. I would
I don't know,
assume
they
it would
have
be that.
a 10 car, 100 client So is this for just 100 of
Only-
those clients? That's quite a bit of distribution, but again, 2008 there was more competition.
Yeah, so like 30 people, 32, 3% was Symbian.
But then the second graph,
Actually, no, because just on the first graph, then in that case, if which one is BlackBerry? Is BlackBerry RIM OS?
RIM, yes.
Yeah.
So you're saying you
32%.
you know that BlackBerry, Windows, and Palm OS make up 32, 62, 81% of the market. But earlier you said that you're still building for iPhone,
BlackBerry.
Symbian, and BlackBerry, which is 45% of the market.
That's
You
a
get what
very
I
good
mean?
catch. Yeah.
And regardless of what that sample data is talking about, it's either the number of users that exist or like potential users. So you're still saying that you can appeal to 85%, but you're appealing to 45%.
No, it's 70, right? RIM is 32, Windows is 30, and then iPhone. So about 72%.
No, but they didn't say Windows, right? They said Symbian, I think.
Okay. Oh, they missed Windows.
There is
Yeah, I'll show you it. 1 second.
the app this thing was, no? Technology, yeah.
Applications for iPhone, BlackBerry, and Symbian.
Yeah, Nokia.
So, yeah, the smartphone requests thing, it doesn't work. But for the below chart, it works because
Yeah.
in that case, like so maybe they're saying that we don't
For the
care
future,
about our crowd
current.
today, but
Hmm.
we're gonna work on Symbian. Yeah, maybe that was the.
Yeah, because it might also be in terms of like growing outside the US. Like Symbian might be popping somewhere else.
Symbian is popping all over the place because all of them, like all regions except North America, are Nokia
So yeah, that's why.
in this thing. Fair.
So they were still at a stage where they were buying cars. Because wasn't Uber at some point where an individual could rent out their car?
Always an aggregator, yeah.
Yeah.
Maybe this wasn't yet the pivot.
Yeah. Before pre.
Like this might just be pre-gig economy.
This might actually just be the car service. And
Yeah,
that's why it makes
because
sense.
they did begin as a pure
Yeah.
cab
Yeah,
service.
yeah. But this slide
'Cause I was-
does help
Yeah.
in terms of where they can go better, get better in the future. Sorry, you were saying something.
No, sorry. I was just saying that that like I was also confused in the sense like where are they going to talk about like the gig economy and like what their entire model essentially was, but it didn't exist at this point in time.
You know what's interesting is Get Here now costs more than Tomorrow at 5 p.m. They tried this, they didn't like go with it because Uber needs to be an on-demand. Like scheduling on
Yeah.
Uber is a very rare thing, but you know where it does work? On Uber Eats.
Yeah.
On Uber Eats in the UK, at least I remember, you get a discount if you say I'm happy with slow delivery. So it's either a free delivery fee
Yeah.
or whatever. But if you want it immediately, then it's a 1-2 pound
Yeah.
charge.
Yeah.
And so it's interesting that an idea from 2008
Made it.
it made it. Yeah, it's still there.
I mean, but that makes sense, right?
In
Like
one
for
of their
food.
pivots,
Yeah.
not in their main business.
Same with Amazon Prime, right? Where-
Yeah.
Marketing ideas. Interesting. One-click cab.
Invite only. Caps too.
I think Uber did start invite only though. I think they did.
Yeah, I guess it fits the luxury market.
Yeah,
Yeah.
they did start invite only.
But that's such a now thing, right? Like to have give that exclusivity
Exclusive.
to things.
Cred, I think I can recollect in Indian companies that just started off in terms of startups,
Yeah.
invite only.
It's very difficult to get invite only, right? Like you have to have a very good word of mouth. Like you
Yeah.
need to have a few celebs
Yeah.
on board in India. You need to have like at least 500 users that you're giving the invite to, and then not to any more. And to 500 people who are using it and telling their friends about it. Yeah, even this is a very important slide, right? To be slide 25.
But I think that it makes sense, right? Like your last slide is where you're like what the logistics are, because these are very logistical things.
Fair, but the provisional patent file that could have been on the technology slide. That's a very important thing because
Yeah.
it's again talking about like a patent has value. You can sell the patent, so it is an asset.
Next, buy 3 cars. Develop app.
Do you think, okay, so one slide that I've not seen here so far.
I can think of many.
Yeah, I mean,
Go.
you can think of any ones that I'll say first is what is your current like asset list? Like if you have
Yeah.
something that you hold already, it can be, it
They
is
spoke
important.
about the cars that they have.
Yeah.
They didn't talk about the number of fleet.
Fleet, yeah.
Yeah.
But yeah, what are your missing
So
slides?
now we can look at it as a whole.
Yeah.
What do you think? Rated out of 10 maybe.
A 4.
Wow.
Fair.
Yeah. But yeah, coming back to the slides that I feel are missing, founder slide, you need to know who is building the
founder,
business, their whole story. At the end of the day, we are backing the founder.
Yeah.
So their past history, whatever, if they've built any previous businesses, if they have expertise in the current, maybe in the tech or in the industry, some background. Again, not looking at degrees or whatsoever, but just their background. And yeah, what are they raising, for how much,
Yeah.
fund valuation is another, and what are they going to use those funds for? Although that is there, but exactly a bifurcation of where those funds will go
Yeah. Allocation is quite important. Yeah.
is what is missing.
And now consider this. Now you gave it a rating of 4 out of 10, but obviously Uber raised funding multiple times and is where they are. So a bad pitch deck is not the end of your
Not at
business.
all, not at all. So as a VC also, you have a negative list, right, where you missed out on investing
Yeah.
in those companies due to whatever reasons.
Yeah.
So yeah, those are your learnings, and that's where you grow. But yeah, definitely a bad pitch deck will not be the only thing to make it a red flag to not invest.
So really, there's no science behind it at all.
It's art.
Because yeah, like we can see how much it's changed since 2008, where it's come now. It's well beyond where they thought it could be as well. And yeah, I guess they needed one person to believe in them to see, because like the main pivot and what it is today wasn't even part of the pitch deck that we saw. They were actually quite simple back then. It was just like a normal car service that they were trying to, I guess, use technology with.
Yeah.
So yeah, that's cool. Any last thoughts on the?
So yeah, when you ask me that question, I would reverse that even a very good pitch deck won't lead to good funding.
Yeah.
So it works both ways.
Yeah. At the end of it, it's still the inherent value. Is it there? Is it not there? And that's what everyone's there to judge.
So yeah, it can't all just be pretty and it'd be easy to get.
I feel like I can make one look very pretty, but even I would keep asking myself that, like, what is the actual?
At the end of the day, you're putting in content that you've actually done work on, or your thought process. So that if that narrates in your pitch deck, then nothing like it.
Fair enough. So now we're gonna move to the next segment, and that is busting the VC myths. So we'll give you 8 statements that are commonly heard when discussing venture capital, and you have to tell us whether it's true or false. In the most objective way. So the first one, your pitch deck shouldn't be more than 7 to 10 slides.
True.
Okay. The average person pitches to about 50 people before getting funding.
True.
A VC's only goal is to have a lucrative exit.
True.
VCs don't give you the true reason for passing on your business.
Sometimes.
When would you lie about it? Like, what are some of the reasons that it just wouldn't, like, where you don't want to tell
Give
them?
us a reason that, like, why you've passed on a business, but not told them that reason.
It can be, now I can't, I'm on a spot, I can't think of it, but there have been cases where we've not, would have not given them the real answer. But our main goal would be, when we are passing on to something, and if we have spent time with the business while we are evaluating that opportunity, to give them why we are actually not investing. So that's the goal, but there have been 1 or 2 cases that I can think of.
A VC will help bring your revenue up.
False.
VCs mainly only invest in tech.
False.
A VC will take over your business.
False. At least for me, for us.
Raising VC funds means your business is successful.
False.
Okay, so yeah, that was all the
We
myths.
somehow got it very half and half. We started with truths,
Yeah,
then
false,
falses.
yeah.
I don't know how that happened.
But do you think VCs used to invest highly in tech and now it's become a little more diversified?
Uh,
I guess they also needed the money versus like a lot of bootstrap companies could generate revenue and make like self-fund it.
so I think it's again the pre and post 2021 era where we saw the boost, and when everyone again now is looking at profitability, everyone's going back to traditional businesses that are actually making money, and if that capital can be used there to grow the business and then see a potential revenue jump and then make money for the VC or PE is where, but primarily for us, we've always looked at in the whole profit pool where the money lies. That's where our focus has been. But yeah, we tech or non-tech, we want to see where the money is.
I feel like tech needed the cash burn for growth mindset. So you needed VC money to be able to do that.
But yeah, now it feels like a tagline, right? Like a lot of startup founders just want to be like VC backed to like put that on there.
Honestly,
But we've seen so many startups now who are returning the remaining.
Oh, really?
Yeah. So many startups shutting down and returning the capital where they see no product market fit after years of operations. And so what's the use of large rounds of funding where you're returning that capital, where that capital could have been deployed somewhere else and made that kind of money?
What is one myth that you would like to bust about the VC world?
VCs are vulture capitalists.
Yeah, like I said, a VC will take over your business. We have seen scenarios with quite a few companies. I don't want to name them, where because of if the company is doing good and they want to put in more money so that they can have larger stake, and there's the founder venture capitalist split, or that's where, because of the whole due diligence and the shareholders agreement, they can have that power because they've put in the money. And there have been scenarios where they have taken over businesses, but usually it's because we are backing the founder.
And until there's any particular reason to, as you said earlier, y'all are backseat drivers. Y'all don't need to get into the operations.
Yeah, we just spoke about raising funds means your business is not successful.
Yeah. I honestly will always believe that healthy revenue is successful business.
And where previous, again, 221 era, where you wanted to see fast growth, now you can see slow growth but sustainable, right? Runway needs to be enough, your internal accruals, your internal checks need to be all right, and slow growth is fine, but the company needs to sustain, and that growth trajectory can slow down. A VC's only goal is to have a lucrative exit. Our job is that is so true, because our job is to give back the money the investors, our LPs, have given us. So that's why we are in the business. That's primary. And that is very true for anyone. And anyone who's saying otherwise is lying.
Do you think India is in like a VC bubble right now?
It's getting out of the bubble. So that's a good thing to start off. Yeah, VC does not help. So the capital does not help to bring your revenues up, because the capital will come in. You will see a slight trajectory. When the money runs out, you're again on a downfall. So that's not helping. It's just the marketing money that's been pushed to see that growth in revenue.
Yeah, I mean, if I do a solid Instagram ads campaign, sure, I'll get some sales for a bit, but does the product last beyond that? You don't know. Let's go on to our final segment.
Okay.
This is the rapid fire. Okay. Very simple stuff. So, first question: top 3 aspects you look for in a pitch deck.
Okay. Problem statement, founder, and market.
What's an immediate red flag in a founder?
Lies. Trust is key.
What's a huge green flag in a business model?
Cash flow, positive cash flow.
The highest amount of money you have lost in an investment.
Mm, currently, none of in personal investment. Or
Yeah. Or in a team that you worked on in a VC.
So thankfully, none of our companies we've lost any money. And personal investments, I have done a few startup investments as well. Those are also going great as of now.
Okay, touch wood.
That's what, yeah. Wow. Okay, in that case, the most amount of money you've made in an investment.
All of it is on paper right now. Personal investments. So that's how it is until you get an exit.
Correct.
Yeah.
Fair. Your most favorite startup founder ever.
I really like Kunal Shah for his. I think he gives very good Twitter wisdom, and I've seen him speak a lot. He is very clear on what he's building. How that replicates into the company over the years in the model is what we have to see. But as a founder, I do realize why he's got the backing of the amounts of fundraising because of the founder promise.
Interesting. Which out of Facebook, Amazon, Apple, Google, Microsoft do you respect the most?
Facebook, Apple,
Apple.
oh, the fan,
Yeah.
except for Netflix. Wow, that's a very tough one because all I can think of is why I don't like that. Why I don't. I think Microsoft. Microsoft because of its distribution. Although even others would have their distribution, but I think more ethical is what I would like to believe.
For some, like my mind always goes to Apple, like in terms of respect, only because so every year when the iPhone comes out, right, everyone shits on every new iPhone when it comes out because they're like, what has changed from last year?
Yeah.
And my saying to them is always that Apple is not a hardware company; it's a software company.
Yeah.
Like they are pulling you into their ecosystem because of the seamlessness. Like if you see, every product that Apple makes, someone else makes it.
Yeah.
But it's the software and all of the software that's pulling them all together that pulls you in. So the idea is not that hey, you bought an iPhone 15, it's not that much better than a 14. Is that when the iPhone 17 is launched and you're still on the 14, you're still having the time of your life.
Yeah.
That's what matters.
And it still gets sold out, like regardless.
The additional features and still.
How many days of leave have you taken in the last year?
Like can't count. In between, you go on your trips, but that's
Healthy amount.
I think 25 to 30 days.
Not bad. That's a good healthy amount.
Yeah.
Fair. What's the weirdest place from where you have worked?
We work only through co-working spaces, but maybe a cab ride in between meetings.
Fair enough. And finally, what's your favorite social media?
Instagram for everyone, but Twitter, now X, for all the content. It's so underrated, but all founders sharing their information, and I think it's one platform that needs to be saved from the future.
Fair enough.
Cool. That brings us to the end of our conversation with you.
Thank you so much for having me.
Thank you so much for coming
Yeah.
on board and just giving us your time, energy, all of it.
And the insights into like the VC world, because it does seem daunting, I guess, for people when they're just starting out, and if they want to delve into this, I guess this gave a little more perspective that it's not the end goal either, but like if you want to get into it, then this is how you should. But yeah.
Yeah, no, I think what I would say is like the main takeaway is what we said, right? Like a great pitch deck doesn't mean you'll get funding, a bad one doesn't mean you'll lose funding. Like, so I think a lot of people put a lot of pressure on themselves that there's no scope for mistakes, but there is. Like, you can make mistakes and you'll still be fine if your idea is good.
You're human, yeah.
Yeah, exactly.
And if you've been rejected by 50, apply to the 51st.
Exactly.
But yeah, thank you so much.
Thank you.